You've been talking about Goldman Sachs and AIG as we have, and the interesting relationship that goes on between the money from the government that ended up going to AIG, but then AIG channeled that money to Goldman Sachs, and then Goldman Sachs channeled that money to its employees, who are going to get huge bonuses, and it's a great way to bypass the real economy, as it's called, that is people who work for a living, and to get the government to subsidize in a way that you could describe as either socialistic or Soviet-era communism, the elites and the oligarchy. Talk a little bit more about the relationship technically, because that's kind of your specialty, between AIG and Goldman Sachs.
Well, AIG, as I've said before and as a lot of other people have noted, wrote all of these credit default swaps without any money behind them at all. They had no ability to pay. Goldman, along with these other banks, and it wasn't just Goldman, it was also banks outside the United States as well, Deutsche Bank and others, were carrying all of these assets on their book at par, that is 100 cents on the dollar. And the reason that they were able to do this, even though the credit quality was deteriorating and people were not paying their bills, is because they had these supposed insurance policies. Well, of course, if the insurer doesn't have any money, your insurance policy is worthless. So in order to get around this problem, Goldman detected that this was going to happen. They're not stupid. They're some of the smartest guys on the street. They hedged their position. Now, they haven't told us how they hedged their position, but what they have said is that over the last 2 years, they've collected on those hedges. So essentially what I believe they did is they probably bought puts on AIG, which would pay off if AIG's stock declined in value. So now Goldman Sachs got paid for their hedge. In other words, they had no economic loss.
And correct me if I'm wrong, but Blankfein, who's the head of Goldman Sachs, was actually in on that meeting, correct?
Absolutely, and Blankfein has said repeatedly that they were fully hedged against the possibility of AIG not being able to pay and going bankrupt. And in fact, it was said during their conference call last quarter that not only were they hedged, but they had collected on those hedges. So essentially what happened here is they made their money. They got paid because they were smart people for the possibility that AIG couldn't pay them on their insurance that they bought. Okay, so that they did the right thing. Then they went to the government and got the government to pay them again. So this is essentially like you having a insurance policy on your house against a fire, but you don't have one insurance policy on your house. You have two insurance policies on your house. Your house burns down and you collect on both of them.
Well, it's ironic. It's incredible that in Congress and in the American public and in the public space, they're debating whether or not Americans, ordinary Americans, should get any insurance at all for health care. But at the same time, companies like Goldman Sachs are getting doubled insurance on any risks that they take. So clearly...
Well, Max, they shouldn't have been paid the second time. Okay,
Right.
The first payment that they got from hedging their bets was entirely normal, entirely ordinary, and entirely fine. When AIG got in trouble, the idea that the government would come in and pay off a bet that had already been hedged and had been covered is absolutely outrageous. That's $13 billion of taxpayer money that went directly to Goldman Sachs. And, you know, they can argue that there was no controlling authority to renegotiate those contracts. I've got a very simple solution to that. Put the company in bankruptcy. They would have gotten nothing.
Yeah, good point. Talking about bankruptcies, how come Lehman Brothers and Bear Stearns were allowed to go bankrupt and Goldman and AIG were not?
Well, because Goldman is the favored people, and we can't let Goldman Sachs go under. You know, there was this whole argument about whether or not they were actually okay in the fall. I don't believe so. I believe they were in a great deal of trouble in the fall. Again, you take the $13 billion that the taxpayer gave Goldman Sachs from these credit default swaps, you take that back out. And where are these great earnings? Okay, what'd they make? A couple of $1 billion last quarter? Hey, take $13 billion off. They've got a big fat loss, right?
Right. Well, AIG is saying that because they were not allowed to go bankrupt, they're now entitled to these bonuses. So again, it's double and triple jeopardy for the American public as these banks ride roughshod over all manner of decency. And I worked on Wall Street for many years myself, and there's so much ridiculous wiggle room in the way the laws are written. And it would seem that these banks would have at least some modicum of shame at some point when it's obvious that all they're doing is just larceny and stealing without end. I see my producer is looking at me and saying, let Carl talk, let Carl talk.
Well, my biggest problem with this entire mess is that when you take loans and you bundle them up and securitize them, essentially what you are doing is committing systemic fraud of some form. And the reason is that the actual amount of profit in a basket of loans, it doesn't matter what they are, I don't care if they're mortgages, commercial loans, whatever they are, is fixed at the time those loans are made. There's a certain spread over non-risk assets, for example, treasuries, which is the reference for everything. And that spread is the maximum amount of profit that anybody can possibly make off of that transaction. That is a fixed number, and it is set at the time that that basket is made and the money is handed out. When you securitize something, you are slicing and dicing this. The maximum amount of money that can be earned can't go up. It can only go down. And in fact, it must go down for everybody that touches the transaction because nobody works for free. So if we take these loans and we slice them and dice them and put them into buckets and do this magic with securitization, all we're changing is how we allocate the profit that is available within this basket of loans. But if I come up with a way to say, let's say that we have $100 million worth of loans and there's $5 million worth of profit in this transaction. If I find some way through securitization to claim that there's $7 million worth of profit there, I've committed fraud. I don't care how you did it. It doesn't make any difference whether a rating agency gave you a bogus rating, whether you lied about credit quality, whether you assumed that people that took out option arms without declaring an income made $250,000 a year. I don't care how you got from A to B. The fact of the matter is that you cannot create value where it didn't previously exist. And everyone that touches these transactions makes money off of it somewhere. So the maximum profit available in a loan transaction happens at the point the loan is originated. Every transaction that takes place, every securitization, every repackaging that takes place after that point decreases the total amount of money that's available to investors. Can never increase.
Okay, now that's a kind of a dissection, if you will. You're looking at a basket of trades. You're talking about securitization. You're talking about distribution of risk and reward. You're talking about Goldman Sachs, who's a primary player, who's out there, who they claim are adding to liquidity in the markets, who are creating fair and orderly markets, who are acting within the bounds of regulations. Clearly, based on what you're saying, they're perpetrating systemic fraud. They're capitalizing on their fraud. They've monetized fraud. Essentially, their business plan is to monetize and trade fraud, and they're making a lot of money doing so. Now, the other layer to this is that they appear to have rigged the New York Stock Exchange itself to actually trigger the events that would kick in for these outsized, oversized, fraudulent gains, as we know from this story of the proprietary trading that was passed on to a competing firm.
Well, we don't know what happened there yet, but we eventually, I suspect, will find out. I mean, there's a number of things that are very fishy about this entire story, and the most important one from my perspective is this SLP program, or Supplemental Liquidity Provider program, that the New York Stock Exchange put into place last year.
Well, we're going to keep our eye on that too, Carl. That's Carl Denninger of market-ticker.org. Thanks so much for being on the show, and thanks too to Stacey Herbert for being on the edge. Until next week, bye, y'all.